Good evening and blessings, everybody out there. What's going on? It's your man, Rod Hickman, Generational Wealth Builders, where poverty ends with a look. It's that time of the evening where we are going to talk a little bit about life insurance. And so, again, now's the time for those of you out there to call a friend, call a neighbor, tell them, hey, that crazy fella is on the line again, because we are talking a little bit about life insurance. Now, again, we're super pleased to let you know that September has been Life Insurance Awareness Month. And I sincerely hope that you have taken some time out, sat down with your loved one, and that you all have looked at your policy, right? I hope that you sat down and taken the time to look at your policy. Why is that important? It's important because as your needs change, you need to make sure that your family is properly protected, right? That is all we want to make sure, right? We want to make sure that your family is properly protected. And can we be honest? You want to make sure that your family is properly protected. Why do I say that? Come on, fellas. You don't want Jody coming in that fast, right? So again, we want to make sure that our families are properly protected, right? So look, talking tonight, because I actually was apprised to a conversation that was had. And y'all know me, again, I'm completely transparent. I don't have anything to hide. And one of the things that was said was, that there are people that insist on buying term and investing the difference, right? Buying term and investing the difference. And I understand there's a whole company out there, that's their methodology. Again, if that works for them, fine. I can say that I was a part of that company back when I first got out of the military. I was a part of that company, so I don't speak down on it, things of that nature. But I also understand when you learn better, you do better. So that's all I'm going to say about that. And that's about as petty as I'm going to get. And I don't think my wife going to fuss at me for saying that. Okay, with that being said, let's talk a little bit about that. The concept is that you will get a term policy, and a term policy allows you to get a lot of life insurance for a relatively low premium, right? So, for example, let's say a young man that's 30 can get a $500,000 worth of insurance for about $68, $70 a month, right? For 30 years. Well, actually with us for 35 years. But again, I'm just going to say that. And so what they're saying is, okay, normally you would pay, and I'm just pulling numbers out of the sky here, you would pay $200 a month for that policy. So if they get you that $500,000 policy for 80, what they're saying is you take that remaining 120 and you throw that into an investment, right? Whether it's a mutual fund or a CD or whatever the case may be. That is the whole concept of buy term and invest the difference. They're getting you to get a term policy for 30 years. Then you take that remaining money and you invest it into the market. Now, here's where they paint you the rosy picture. They'll say that over the past 30 years, the market has done on average about X%. Now, I'm not going into that tonight, but that's how they paint you the picture. And what they say is by the time you get to age such and such, you'll have X amount in your investment account. And all you have to do then, you don't need life insurance anymore. You can now live off of that, right? So that is the psychology behind the buy term, invest the difference, right? You buy the term policy, you get that $500,000, you pay that, whatever else, you just invest that away into that and you live off that money. Now, that's all fine, blue sky, except they don't tell you a few things about that, right? What they don't tell you is you get taxed on the growth. They don't tell you about that. So even if you did have $1 million, you have to ask yourself the question, how much am I going to have to pay in taxes? So, and what is that going to leave me with? See, these are questions people don't ask because you don't know to ask, but because I've been behind the iron curtain and because I know what's going on, I can help you ask the right questions. And so that's what we're going to do tonight. So either way, based on that premise, the post said that whole life is trash. Whole life is the devil. That's, what they say. And so I was like, well, I'm not going to necessarily argue with them on that. But here we go again. I always love being able to show people so you can make the decision. You, as the consumer, need to be able to make the decision. And so that's what I'm looking to do tonight, to empower you with information for you to make an informed decision. So here we go. Whole life versus IUL. Which works better for you? Now, y'all see these fancy graphics? Yeah, y'all didn't know your boy was rocking it like that, right? So let's take a look at this, right? So anytime you look at a whole life or IUL, the characteristics of these policies are what we call permanent policies, right? Meaning that the death benefit stays with you. A term policy, think of it as a rental car. With a rental car, you have to give it back. And so while you have that rental car, you keep that same rate. But at the end of that period, you give the car back, you walk away, right? That's the same premise with term insurance. However, when it comes to permanent policies, basically they're designed to build cash value that you can access tax-free. Here's another fun fact, folks. Your money that's in your bank account, I want you all to look and see that when you do get money and your money does grow, I want you to really take a look because you get taxed on that money. Well, the way the permanent policies are designed to grow, again, if you set it up right, so you've got to make sure that you're sitting with somebody that knows what they're doing because they can mess around and mess you off. But they can make sure that your policy grows and you have access to that cash value tax-free. This is what we present to our clients as a LIRP, or what's called a life insurance retirement plan. This is specifically great for those who are self-employed, contractors, people that are in positions where their company does not offer a retirement or anything like that, right? You can build cash value through your life insurance policy. Again, for business owners, you definitely need this because what happens is this allows you to be able, if you overfund it properly, then now you have access to this capital as a tax-free loan. All you have to do is pay yourself back, right? It can provide a lifetime death benefit up to the age of 131, and it still costs the same amount per month. And then the cash value can actually supplement the retirement income. We talked about that a little earlier, right? Meaning that with the cash value, you can turn around and have them pay you a percentage of that money each month. Now, the cons to it is that it does cost more, right? It does cost more, but that's because it has a savings component, right? I know, listen, I've been doing this long enough now. I got about 4 years in the game, but I know when people talk about they want insurance, they always go low. How much you want to spend on insurance? About $100. Okay, I figured that. Well, let me show you what you can get for $100. Let me take you over here to the cheap side, right? But again, the way these policies are designed, they are designed to grow your cash value. They're designed to be vehicles that will grow your cash value, right? So again, there are fees tied to this policy and they can increase. And if it's not proper structurally, it can lapse, right? And so this is why you got to make sure, and I'll show you an example on here tonight, because again, I want you to be informed. I'm not trying to say I want you to be informed. So let's go to the next slide. Boom. Boom. So let's look at a whole life example. So this is for a 45-year-old man. And this 45-year-old man wants $100,000 worth of life insurance. Now, listen, I need y'all to follow the numbers. So if you have to go back and play this again, listen, that's okay. But I really, really want y'all to understand this. This is about a whole life insurance. And what we teach our clients, again, even before they become our clients, again, because we're so certain about this, we give our clients 4 questions to ask their carriers. And a lot of times, once they ask that, they come back fighting mad. But let's take a look at this, right? So basically here you see that we could get them $100,000 for about $163 a month. So what that means is annually he's paying in about $1,958.88. Now, you've heard me talk about how you can overfund this policy. Well, here's the thing about it. Uncle Sugar ain't going to let you just go out there and wild out now. So they've created what's called a MEC premium. And basically what that means is if you go over this amount at any time in this policy now becomes taxable. And so you don't want that, right? Because right now, according to IRC tax code 7702, your life insurance policy is tax-free, right? So I just need y'all to understand that. So again, that's what this MEC premium, it means you cannot add any more than $5,200 and $44 over the life of this policy. All right. All right. So let's take a look. Now, I want you to see here, because y'all have heard me say this a lot of times on this show, that people lie, numbers don't. Right? People lie, numbers do not. So I want you to see something here. So what we're seeing here is, if he's paying the 1958.88, they rounded up to 1959. The first year he get a $10 cash value increase, right? That's how much they're giving him in cash value year one. Year two, he's still paying that 1959. They're giving him a $30 increase. Now he got $41 in tax value. But y'all look at him. How in the world is it that he's they got 60 additional dollars to the death benefit? So he got $100,060, right? All right, that's all good. But let's get down to year three. You get to year three, and you see the cash value that's given is $1,418. You multiply, you add that plus that $1,441. They're saying you got $1,459 in cash value. But look at the death benefit. What that means is, if this individual passed, the family only gets the $100,157. So the question becomes, folks, what happens to the other $1,300 some odd dollars? That's the question, right? But let's go on. The next year they give him another $1,500. He got almost $3,000 in there. But look at the death benefit, $283. Another $1,900, $434. $2,000, $615. Not gonna nickel and dime you. You get down to age 64. Notice you got $41,000 in cash value, but look at the death benefit. The death benefit, you only have $109,000. So, folks, what does that mean? This means that if this person passed, the family would only get $109,034 at the age of 64. So the question now becomes, what happens to that other $32,000? What happens to it? It stays with the carrier. Yeah, you heard me. It stays with the carrier. This is what people don't know. This is what people won't teach you. Now, here we go again. I want y'all to understand. Don't think I'm out here trashing these policies because I can write them. That's how I got access to these numbers. I can write a whole life policy, but what I want people to understand is that you need to understand why insurance has gotten a bad name. Insurance has gotten a bad name because you have people that are greedy and they're doing what's best for them instead of doing what's best for the customer. So what I can do, I can arm you with information so that you can ask these questions. All right, so let's say another thing. So let's say they call you and say, hey, man, you got $41,000 in cash value, and you pull that out. And you pull it out and you don't pay it back, and God forbid you pass. Don't you know they're going to take that $41,000 out of this 109? And that's what your family is going to get. Yeah, that's how whole life policies work. This is not your money, right? It's not yours. It comes to you as a loan. All right, so let's look a little further. You keep on going. Notice the cash value is steadily going up, but look at the death benefit. Look at the death benefit. So then watch this. You get to the age of 106. I mean, you get to the age of 83. And now you got $106,000 in cash value. And guess what? Now, if you pull that out, your family would still get $34,000. How tragic is that? You paid into this policy for 39 years. That's all your family gonna get? Come on, man. That's what people don't know. So let's keep going on. So let's talk a little bit about the index universal life. Let me see if I got anybody in the chat real quick. Anybody saying nothing? No, y'all ain't saying nothing. All right, let's keep it popping. All right, so let's just say with the index universal life. Now, notice same thing, 45-year-old person. First thing you notice here, is the model premium is $140. So what that means is it is $23 cheaper than the whole life policy. Make sense? So that's saving almost $300 a year. Pay attention to that. Remember, I told you, if it's not structured right, it will lapse. So basically what we're saying here, if you get a IUL policy and you do not want it to lapse, you are going to have to overfund that, but we'll talk about that later. So that's what that lapse year means. Now look at here. So basically we read this, $140 times 12 is about $1,681, right? Now let's go to it. So now if you look here, you got 1681. Look at it, they're giving you 987. First year, 987 to the death benefit. Year 2, 2015. Look at that, 2015. Year 3, 3086. Boom. If we get down here to age 64, notice now how you have $37,715 in cash value, and look at your death benefit. You have the same amount in the death benefit. So what does that mean? That means if you pull that money out, your family still get about that $100,000. Now, I want y'all to notice something real quick because this is a numbers game. So let me go back up. Notice here in 20 years, even though you're paying almost $300 a year more, you have $41,000 here. How is it you have $37,000 right here? How in the world can you be within $4,000 and you are literally paying, you pay what? Almost $6,000 less in premiums in the same 20 years. And you're $4,000 closer. So that basically means you're getting more value for your money. Does that make sense? You're paying less, but you're getting more of value. All right, but I ain't gonna stop there. Let's keep going. So now let's look at it. We go to the same age 83. Oh, wow, look at him. You have $100,000 in cash value. And oh, look, then your death benefit is $200,000. So what does that tell you? If you don't touch that money, your family gets the $200,000. If you pull this $100,000 out, your family still gets that $100,000. Now remember, when we looked at the other one at age 83, it was 106. So here we go again. We're 39 years in, and you're still $6,000 away. You saved $6,000 for your own self, and you still have more money. Because look at your death benefit. So let's go back. All right. So I hope this makes a little sense to you. This is what we teach our clients. This is why we're growing like we're growing. Because when people see it, it's a no-brainer, right? Now, remember I told you, you got to structure it right. So here's the question that I want to ask you all on tonight. What if you buy an IUL and invest to the guideline level premium? Now, Hickman, what is the guideline level premium? Well, let me go back real quick. So when you look at the guideline level premium, folks, this is the amount that you can actually put into this policy every single year. And it'll grow tax-free, right? That's why I say it got to be structured right. You got to know who you're working with. So if we come down, let's take a look. So now this individual is buying an IUL and they're investing the difference. So they're paying $5,800 a year. Look at how their cash value is growing. Boom, 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 boom. Let's get down to 64. In 20 years, this person has now just put in about $58.82 for 20 years, which is $117,000, but they have $196. That's what you call buying the IUL and investing the difference. And folks, guess what? You have access to this cash value tax-free at any point in time. So let's keep going. So now we get to the ripe old age of 83. And so if we just let's just go to 84 to make it easy numbers. So where you would have invested in your life insurance policy $235,000, you actually would have about $859,000. $859,000 that, again, if it's structured right, you get that money tax-free. Come on, folks. Somebody ought to say something. This is what we do here at Generational Wealth Building. So in closing, why would you just buy term and invest the difference when you can buy IUL and invest it in yourself? And so, folks, that's what I wanted to share with you all on tonight. As we are ending and concluding Life Insurance Awareness Month, I want to make sure that you are properly protected. I want to make sure all of our agents, all of our upcoming agency owners, all of our partners want to make sure that you have the right policy for what you need, right? This is why you don't listen. If you have this type of policy, you don't need to go and pull from your 401k and pay a 40% penalty or almost 40% penalty. You don't need to do that because you have access to the cash value that's in the life insurance policy. Folks, this is what we educate people on. Again, watch this. We can even help you get a term policy if you want to supplement and increase your amount of insurance. Because again, I don't not term. I sell term. But again, we sell term, that's a different fashion. We sell term as a healthcare supplement plan. What do you mean by that, Hickman? Our term is for the living benefits. What are the living benefits, Hickman? It is, God forbid, if you're diagnosed with a critical, a chronic, or a terminal illness and or injury, where you can get anywhere from 75 to 80% of your death benefit while you're still alive. Oh, Hickman, make it pretty for me. Again, God forbid you get on dialysis. God forbid you have a heart attack. God forbid you have a stroke. What if something happens? You're in a car wreck, right? Every one of us leave our homes every day with the anticipation of coming home, kissing our loved ones, doing this, doing that, going bowling, playing bingo, whatever the case may be. But what if one day you leave the house and somebody's not paying attention while they're driving, and now all of a sudden you're in a wreck? What are you going to do? You're in a wreck where you now are going through some changes. Would it not be helpful for your life insurance company to call you and say, hey, my man, sorry about what you're going through. Rod or one of his team told us what you're going through. And we spoke with your doctor. And based on that, here it is. We're going to give you 50% of your death benefit while you're still alive. 70% of your death benefit, 80% of your death benefit. Here it is. You got $1 million policy. Here's $500,000 for you to get better. You got $1 million policy. Here's $800,000. That's why I said earlier this month, again, there's a method to my madness always. That's why I said every individual needs to have at least, a working individual needs to have at least a $500,000 life insurance policy on every one of them, right? Every one of them. Your children, bare minimum, $250,000. That's what they need to have on them. Why? Because of the living benefits. And here we go again. With your children, they can't get a term until they turn 18. So you've actually got to get them an IUL, which if you do it right, we can show you how to do what the Rockefellers do with their children. You can't do that with a whole life policy because their MEC is lifetime. So whatever that number is, that's for the lifetime. You can't invest in that. So these are the kind of things why we're here to educate you. And again, Life Insurance Awareness Month may be gone, but that don't mean you can't get your life insurance policies where they need to be. So listen, that's my time tonight. I'm finna go and get me something to eat. But again, I just wanted to share that with you on tonight. And I hope that you will take advantage of this information. I hope you'll like it. I hope you'll share it with somebody. I hope you'll reach out to me. Again, inbox me. I love hearing from you all. You all know I'll respond to you. But again, please, please, please make sure you're protected. Don't wait until something happens, then you try to get protected. It's not going to happen, fam. I'm telling you now. And that's the sad part about it. When you wait until something happens, now you can't get the proper coverage you need. And even if I can insure you, you're not going to get the best value. That's just being 100. And that's just not with me. That's with anybody, right? You want to make sure that right now, while you're healthy, right now, today, make a decision that I am going to get the right amount of life insurance that I need. If you are a husband and a wife, you both need at least $1 million on you to make sure that your families are taken care of. $1 million? Yep, exactly right. Because why is that? You need to make sure that your family is taken care of after the funeral. Don't y'all know that all GoFundMe does is pay for the funeral? Barely. Don't y'all know that? No, times are hard on the boulevard now. Folk ain't just giving away money like they used to. So this is why it's important for you to make sure that your family is taken care of today. Come on, brothers. Come on, man. You can't have your children call nobody else Mr. Nothing. You know, come on now. No, bro, you ain't even in the grave cold. But if you don't take care of that, guess what? You put your wife in a position like that. We often say that a life insurance policy is the love letter from the great beyond, right? Whether you have one, if you have one, it's a love letter. If you don't, it's a got him, right? I wasted all this time telling you how much I love you, but I can't show you when you need it the most, right? That's what it does. So again, Life Insurance Awareness Month, it ends tonight, but it really does not end. Again, you need life insurance. If you've had a new baby, if you've had a new grandbaby, you need life insurance. You need to review your policy. And here's the thing, folks. We give out complimentary policy reviews. We don't try to sell you. All we want you to do is make sure you know what you have. Because if you know what you have and you're okay with it, then guess what? When whatever happens, your family just has to be okay with it. But I got insurance on the job. I just saw earlier this month where Big Lots is closing. Big Lots is just closing. The one in Covington, they just opened it. I believe it was a year, maybe a year and a half ago. And now it's already closing as part of that bankruptcy proceeding. So what are you going to do about your insurance there? Let's say you've been there 5 years, right? And you've had insurance there. Now you're not going to have life insurance. And so now if you would have had a private policy before you started there and kept it, guess what? You would have locked that rate in. But now it's 5 years later. And if life has happened, if things have happened, now you're going to be paying more money for that policy. So again, I understand, but I understand people don't know and they don't understand, but that's where you have to make sure you're asking the right questions. You can't just keep going on, right? Again, I'm saying it as I get ready to get up out of here. I'm closing my backpack now. I'm telling you right now that if you are a couple, y'all need to make sure that y'all at least have $1 million on each one of y'all. Period. If you're a couple with children, if y'all have a home, even if you don't have a home, you still need one. Why? Because your family is going to need somewhere to go. God forbid if something happens. You don't want your family to have to move back with mom, dudes. Come on now. Come on. We have to do better. And I have grown tired of this excuse of, well, you know, it costs too much. Y'all don't say that when y'all buy them cowboy jerseys. Y'all don't say that when y'all go to Cancun. Y'all don't say that when y'all do all of that. We don't hear nothing about that. We don't hear nothing about the cost then, but we hear about the cost when it comes to making sure that your family is taken care of. I ain't fussing. I'm just saying, because it's Life Insurance Awareness Month, and I can do that. So again, been my pleasure to be with you all on tonight. We definitely appreciate those of you all that liked and shared. Again, we always appreciate your support. May the Lord bless you. And remember that knowledge is not power until it is applied. You can have an 18-wheeler truck that's gassed up, ready to go. And you can rev on it all day long, but it's not until you apply that clutch and put it in gear that it's actually going to go somewhere. Y'all have a good night. May the Lord bless you real good. And look at here, don't forget Life Insurance Awareness Month. It is here. And so let us make sure that we are doing what we need to do. All right. Y'all have a good night and God bless.